In this video, we're going to look at Golden Entertainment, a gaming company based in Nevada. It operates casinos, taverns, and slot routes. It is the largest tavern operator and largest slot route operator in Nevada. It has 10 casino resorts, 9 in southern Nevada and 1 in Maryland. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. I also look at the company's ratios and compare them to its competitors. And I do this with you throughout the entire video, so it's like we're doing it together. So let's get started with the model. This company has a market cap of $229.7 million. So it's a pretty small company. It's a micro-cap company. And let's get the stock price. It's trading at $8.19, so one share is a little more than $8. So let's pull the free cash flow, and the way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. That's exactly what I'm doing in this video. And they have 1 year with negative free cash flows. Now let's get the net income, which is the profit and loss on the income statement. And we'll put that into the model. And they have negative net income in 2 years. And let's get the revenue. And their revenue has grown quite a bit. It went from 400 million to 973 million in just 3 years. It more than doubled. So this is the company's cash flow statement on their 10K, which is a lot easier to look at than on Yahoo. And this is a good way to get the real fine details. As you can see, they had 7 million of free cash flow in 2019. And that's just a calculation of cash flow from operations, 113.9 million, which is right here, minus CapEx, capital expenditures. CapEx is property, plant, and equipment. So if you purchase a building, if you purchase a vehicle, if you purchase a large machine to operate your business, that's what CapEx is. Those are usually large cash expenses, but you depreciate it on the income statement over a long period of time. A metric I like to look at is if the free cash flow is above the net income. Because if it's below the net income, the company may not be too efficient, or it could be investing a lot in its business, but you got to make sure that's the case. In 2019 and 18, their free cash flow was above their net income, but not so much in 2017. We don't have the 2016 details on this chart. To look at the cash flow statement, the first step is you need the net income. So the net income for 2019 was negative 40 million. And that's rounded, but it's actually right here, negative 39.5 million. And then what you do is you add back non-cash items that you expensed on your income statement. So depreciation and amortization you have to add back. You have to also add back amortization, share-based compensation, and there's some other non-cash items like change in fair value of derivatives. But there are actual cash items that you have to adjust for on the cash flow statement because they do affect your day-to-day business. An interesting thing I noticed is the fluctuations in accounts payable. When your accounts payable goes up, your cash goes up. And when your accounts payable goes down, your cash goes down. Accounts payable is how much money you owe to others. This company may have purchased $1 million of poker chips. So they received the chips, but they didn't pay anything. They're on credit, kind of like a credit card, so they're going to pay them in 60 or 90 days. When you use accounts payable, it's the same thing as taking a loan. When you go to the bank and take a loan out, your cash goes up. Of course, you have more debt and you have to pay it back in the future. In the short term, your cash does go up. In my example for the poker chips, their cash balance didn't actually go up $1 million, but in theory it did because they should have paid that $1 million. So the cash should have went down $1 million, but it didn't go down $1 million. It will go down $1 million when they pay it in the future. So that's why their cash balance actually goes up, because that's how they have to report it on their balance sheet. So you can see their free cash flow went from negative 7 million to positive 29 million to positive 7 million. So in 2017, the accounts payable detracted 22 million in cash, And in 2018, it detracted $5 million of cash, which is a $17 million swing into the positive territory. Then in 2019, accounts payable increased cash $11.5 million. There's lots of other things going on here which affect free cash flow, but this one I thought stood out the most to me. And in future videos, I'll try to delve into other things as well. Let's move on with the model. Let's look at the capital structure of the company so we can figure out what discount rate to apply to the future cash flows. Let's see how much debt they have. We'll go to liabilities section of the balance sheet. $8.5 million of current debt, that's debt due within 12 months. $1.1 billion of long-term debt, that's debt due after 12 months. They pay 6.5% interest on their debt. They don't pay taxes according to their income statement. Let's get the cost of equity, so we need the beta. The beta is how volatile the stock is. It's really volatile, 2.33, so that means it's a pretty risky stock to invest in. Let's get some more information from the balance sheet. Let's get their current assets. And current assets are mainly cash, accounts receivables, and inventory. And we need current assets to calculate the current ratio later, and that's $160 million. And then we need the current liabilities to calculate the current ratio as well. That's $132 million. And these are payables that are due within 12 months. And the equity is $289 million. That's assets minus liabilities. That's the value of the company. Let's go back to the income statement and get their EBIT, earnings before interest and taxes. That's $50 million. And we need to look at their capital structure to figure out the weighted average cost of capital. So the cost of debt is 6.5%, and they have 80% debt. The cost of equity is 20.2%, and they have 20% equity. So the WACC is 9.3%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. That's $328 million. And we discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $807 million. We divide that by 28 million shares, and we get an intrinsic stock price at $29. It's trading at $8.19, so it's trading at a 72% discount. So it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're at $24.46, so they're also saying the stock is undervalued. And you can see the stock has been moving all over the place. It hit almost $35 a couple years ago. Let's look at the financial ratios to get more information on the company. They have a negative PE, a good price to sales, and a good price to book. So they have a negative PE because they have negative net income. When a company has a negative PE, you should look at the price to sales ratio, and they have a great price to sales ratio. That's stock price over sales per share. To get sales per share, that's revenue over shares outstanding. So they're providing a really good value for this ratio. They also have a great price to book. If they say price to book is under 1, it's really undervalued stock. And they have a 0.8 price to book. That's stock price $8.19 over book value per share $10.41. To get book value, it's equity over shares outstanding. This implies that the company is worth more in bankruptcy than it is running its operations. Current ratio 1.2, negative ROE. So current ratio is current assets 160 over current liabilities 133, so they can cover their current liabilities. ROE is negative because they have negative net income. They can't cover their interest payments. Their EBIT is less than the interest expense, which is really concerning because if they don't fix this, they could go into bankruptcy. The best way to look at ratios is to compare them to similar companies. I've done videos on Boyd Gaming, Eldorado Resorts, MGM Resorts, and Penn National Gaming. And right here is Golden in the middle. And if Golden has a number in red, they're worse than the average. If they're in green, they're better than the average. So in PE, you can't really look at that PE because it's negative, but they do have the best price to sales ratio and price to book ratio. They are above 1 in current ratio. Some of the companies are below 1. They have negative ROE, and they have the most debt of all the companies. In terms of market cap, they're the smallest company. So this company is a big risk because they don't look too stable, but if they can get through the pandemic unscathed and still come out with some positive cash flow and a little profit, they might be able to blow up again and become really big. But there's also a pretty good chance they just might go bankrupt this year or next. Let me know what you think of the video. Thanks for watching.